Good evening, everyone. Hopefully you can all hear me all right. For those that don't know me, I'm Tom Harvey with J. Edward Sellers, and yeah, just going to go through a session on today's budget. Going to make sure that we're sharing the right screen, which yeah, I believe we now are. So yeah, hopefully you've caught some of the day's proceedings. It's been a bit of a tumultuous run up to this budget, but we'll try and unpack as much of it as possible today. Just a bit of housekeeping to begin with. The session will last about 30 minutes and there'll be some time to ask questions at the end. Also, if you wanted to speak with one of our advisors about your circumstances, you can scan the QR code, which is on screen now, and book in a free consultation at a time convenient to you. None of the information in the presentation today should be regarded as financial advice or a personal recommendation. If you'd like to receive advice on your own situation, give us a call on the number on screen now. Or alternatively, yeah, scan the code. Yeah, so very short agenda for today's session. So we're going to have an overview of the budget and then that question and answer session at the end. So yeah, cutting through the noise of today's session. So it's fair to say the run up to this budget has been unusually turbulent. We've had lots of leaks, speculation, and even the OBR's own assessment appearing online before the Chancellor had a chance to clear her throat. Then, of course, came a rather pointed response from Kemi Badenoch. While the political noise makes good headlines, our goal this evening is to cut through that, to look calmly at what's been announced and what it means in practical terms for both individuals and small businesses. So what are the main announcements? Let's have a look at the quick overview of the key changes. So first, there was the freeze on income tax and national insurance thresholds, often referred to as fiscal drag. What that means is, as wages rise, for example, through inflation or pay reviews, more of your income gradually moves into higher tax bands, even though the headline rates haven't changed. Next, there are increases to tax on dividends and savings and property income, effectively a 2 percentage point raise across the board. That's important for business owners taking dividends, landlords, and anyone receiving investment income. Then there's reforms impacting pensions, particularly around salary sacrifice arrangements, where the tax and national insurance advantages will be capped from 2029. Alongside that, there are also changes to ISA allowances and other savings incentives, which we'll unpack shortly. For property owners and landlords, there are higher property income tax rates coming in and a new mansion tax style surcharge for homes above 2 million. Finally, there are some support measures to balance out the tax rises. The state pension will increase again under triple lock, and there's a national minimum wage rise and some targeted social support for vulnerable groups. So in short, this budget combines higher taxes on income, investment and property with a few measures to support lower earners, pensioners. It's designed to raise revenue from trying to repeal FAIR. The practical impact will vary a lot depending on your income mix and circumstances. Now let's talk about the threshold freeze, one of the most significant and arguably less visible parts of the budget. The Chancellor has confirmed that income tax and national insurance thresholds will remain frozen for another 3 years, taking us right through to 2031. On the surface, nothing seems to change. The basic rate stays at 20%, the higher rate at 40%, and so on. But because those thresholds aren't moving in line with inflation and wage growth, importantly, growth in the state pension, more and more people are pulled into higher rate tax bands as their pay rises. That's often referred to as fiscal drag or a stealth tax. You don't see the rate going up, but over time, the government collects more in tax as earnings grow. For most employees, that means a gradual reduction in take-home pay in real terms, particularly for those in middle income bracket who are seeing modest pay rises just to keep up with inflation. For small business owners, it's equally important. If you take an income through a mix of salary and dividends, frozen thresholds change the most efficient way to draw income from your business. It's also worth reviewing that balance, especially as dividend tax rates have also increased. So this is one of those areas that looks subtle on paper, but over the next few years, it will have quite a broad and compounding effect. Moving on to another key area, so tax on investment income, one that will be in the forefront of minds for our clients. The Chancellor confirmed that dividend income, savings income and property income tax rates will rise by 2 percentage points across the board. So this means if you're receiving dividends from company shares, rental income from property, or interest on savings, you'll see a higher slice of that income going to the Treasury from next tax year. For business owners who pay themselves partly through dividends, this is a direct hit. Your personal tax bill will rise even if your income hasn't. For savers and investors, it reduces your after-tax income, your after-tax return, which might make you reconsider where you're putting your money. So you may focus on pensions or ISAs as the tax advantages are still there. You may reassess how much income you take as dividend or salary, because that's obviously changed as well. So whilst this isn't a big headline measure, it's one of those quiet changes that have real impacts over time, particularly for anyone relying on investment or rental income as part of their overall earnings. Okay, so the next change is one that is really important for anyone using salary sacrifice arrangements to build up their pension, and it's one that previously has flown a bit under the radar. So from April 2029, the government will introduce a £2,000 a year annual cap on the amount that can be paid into a pension via salary sacrifice, while still qualifying for the full national insurance relief, both for employees and employers. Anything contributed above the £2,000 threshold will still go into your pension, but it will be treated as a standard pension contribution, meaning no national insurance savings. This is quite a significant shift, particularly for higher earners or employers who have been using salary sacrifice as a way to increase pension efficiency and reduce payroll cost. To put it simply, the NI Advantage, which could amount to hundreds, if not thousands of pounds a year, will now be capped. So unless there are changes in how contributions are structured, many people will see lower overall reliefs on their pension savings after 2029. The key takeaway is that this change makes it really important to review your retirement planning strategy. For some, that might mean adjusting the mix between salary, bonuses, and pension contributions. For others, it might mean exploring other tax-efficient options for longer-term savings. Either way, this is a change worth planning for sooner rather than later, because again, its impact will build over time. And we've got that cap coming in at a defined date in just under 4 years' time. Let's turn to property, which has once again been a key target in this budget. The government certainly doesn't like landlords. From April 27, tax rates on property income, that's the income landlords earn on private rentals, will rise by 2 percentage points. This means that the rate goes to 22% for basic rate pairs, 42% for higher rate, and 47% for additional rate. So landlords and buy-to-let investors, this directly affects their net return on rental income. When you combine this with higher borrowing costs, tighter regulations on renting, it doesn't make it as attractive as it once was to be a landlord. In practice, some landlords may try and pass on some of these costs to tenants through higher rents over time, although the rental market will only bear so much. Others may decide to sell properties or scale back portfolios, which could affect supply in certain parts of the rental market. On top of that, from April 2028, we'll see the introduction of high value council tax surcharge, informally called a mansion tax. This will apply to residential properties valued above 2 million, adding an extra annual cost to ownership. For homeowners in that category, it means higher ongoing holding costs, even if they're not generating a rental income from the property. Overall, these measures signal a clear shift. Property ownership and investment are being positioned as areas the government expects to raise more revenue. It's worth reviewing your property portfolio or home ownership plans in light of this, especially if property forms a large part of your wealth or income strategy. Okay, so one that was kind of expected. We'll look at the changes to ISAs next. So from April 27, the annual cash ISA limit for those under 65 will be cut from 20,000 to 12,000. The important detail, though, is that the overall ISA allowance stays at 20,000. So you can still save up to that total, but anything above 12,000 would need to go to a stocks and shares ISA or other qualifying investment ISA. This move is intended to shift behaviour away from cash and towards longer term investment. And the Chancellor made the point directly in her speech, highlighting that somebody that had invested £1,000 a year from 1999 into a stocks and shares ISA would be around 50,000 better off than someone that had done the same thing but stuck it in a cash ISA. Now, of course, past performance isn't guaranteed of any future returns, but it's a striking illustration of how over time the power of compounding and market growth can really affect long-term rewards. For savers, though, this means thinking carefully about your comfort with investment risk and your time horizon. Cash ISAs still have a role for short-term goals and emergency funds, but anything longer term, the budget is clearly nudging people to consider investing that money. Firstly, I think it's a sensible step. It encourages people to build real long-term wealth rather than just parking cash, which may struggle to keep pace with inflation. And if we look at our economy and the nation as a whole, the amount that we invest in the stock market in comparison to other developed nations is remarkably low. So I think only good things can come of this over time, bearing those risk levels in mind. So the takeaway here is not that you should be taking on risk blindly, but it's worth reevaluating how your ISA allowance is being used, especially if most of it sits in cash. Okay, so next on to VCTs and EISs, or venture capital trusts and enterprise investment schemes. So these are long-standing tax advantage schemes designed to encourage investment into young and growing UK companies, and the Chancellor's made some significant adjustments. The first set of changes is positive, particularly for growing businesses. The investment limits are being increased quite substantially. So from next year, companies can now receive up to 10 million of investments under these schemes, or 20 million if they're classed as knowledge-intensive companies, which generally means they're R&D heavy or technology driven. The lifetime cap also rises to 24 million or 40 million for knowledge intensive companies. The idea here is it allows these schemes to support not just early startups, but also scale-ups. So they've got over that initial hump of starting the business, they're now really scaling things up. So for businesses, from a business perspective, that's quite a welcome development. It opens the door to more substantial funding rounds with tax-efficient framework of EIS VCT. However, and it's quite a big however, there's also a reduction in the upfront tax relief or income tax relief for VCT investors. So this is, i.e., the investor putting money into these type of schemes. From April 2026, the income tax relief on VCT investments will be cut from 30% to 20%. That's a significant drop, and it does change the investment equation quite a bit. VCTs are already high risk and relatively illiquid investments. You're typically locking your money away for at least 5 years, and that 30% tax relief is quite a big part of why the investments become worthwhile. With early stage startup businesses, not all of them will make it. Quite a high proportion will fail. So there's a real possibility of complete capital loss. So while the policy intention is to get more money flowing into UK growth companies, the reduced relief could make it harder to attract investors' capital. So in short, it's good news for companies seeking funding, but potentially less attractive for private investors who were previously motivated by that 30% tax relief. So what do these changes actually mean in practice for investors, businesses, and us as advisors? So on the positive side, this reform does open the door to a broader range of companies to qualify for VCT and EIS funding. Up to now, the schemes were heavily focused on early stage startups. The newer limit means that more established and scaling businesses, especially those in tech, renewable energy, or advanced manufacturing, can access capital of this kind. That should help bridge the gap between early funding and next stage growth. For investors, however, the picture is more mixed. While there are no more opportunities to invest, the reduction in upfront tax relief from 30 to 20% makes the risk-reward balance less compelling. Remember, VCTs carry high risk, lower liquidity, and you're locking your money away for several years investing in smaller, less diversified companies. With less immediate tax relief, for some investors may decide it's no longer worth it, or they might prefer to use pension or ISA allowances instead. We always say ISAs and pensions should be used anywhere, well, way before you even think about EIS and VCT, because of the risks that are there. So for smaller to medium-sized enterprises and scale-ups, the increased limits could be a real lifeline. They'll be able to raise larger amounts of capital, but there's a caveat. This only works if VCT managers and investors continue to supply the capital. So if the incentives aren't there, the money's not going to flow there. Excuse me. And finally, for advisors and clients, this is an important moment to reassess the role of VCTs and EIS in a wider investment strategy. They still have a place, particularly for experienced investors who value long-term growth and potential for diversification. But it's essential to revisit the assumptions about risk, liquidity, and after-tax return. In short, these schemes are evolving from a tax-driven opportunity to a more genuine growth investment choice, and that means conversations about suitability and time horizon are more critical now than ever. So let's turn now to business, because there are several measures here that directly apply how much companies, particularly those in retail, hospitality and leisure, will pay in property-related tax. So starting with business rates, the government has announced that the existing reliefs for smaller properties in these sectors will be extended. So if your commercial property has a rateable value under 500,000, you will benefit from a lower business rates multiplier, which should help ease some of your ongoing cost pressures on high street and hospitality. However, for larger, higher value properties, those with a rateable value above 500,000, a newer, high value business rates multiplier will apply. In practice, that means that bigger premises, chains, and commercial landlords are likely to see property taxes increase. To help smooth the impacts, there are transitional reliefs, effectively phasing in the effects of the latest property re-evaluation over the next few years. That should prevent sharp, sudden increases in rates for some firms. On the capital side, there's a bit of good news. The government is maintaining and in some cases expanding reliefs for business asset investment and write-offs. Excuse me. That's part of the push to encourage entrepreneurship and productivity, and to make sure companies keep investing in equipment, technology and growth. So overall, smaller, modest value businesses, particularly those operating from physical premises, these measures may ease some of the cost pressures they've faced in recent years. But for larger operators or landlords in commercial property, the outlook is less favourable. A combination of higher multipliers and revaluation will mean rising costs over time. The key takeaway here is that the government is trying to strike a balance between supporting small, community-based businesses while shifting excuse me, more of the burden towards those with deeper pockets and higher value holdings. Okay, so inheritance tax was one that was in the crosshairs last time. There's been a few changes here. So we're going to look at estate planning and succession planning changes, which are particularly relevant for business owners, landlords, and family enterprises. Excuse me. First, the good news is the unused agricultural and property relief allowances up to £1 million will now be transferable between spouses and civil partners. That's a helpful and pragmatic change. It means that if one partner doesn't use their relief in full, the other can effectively inherit the unused allowance. So very similar to what happens with the nil rate band and residence nil rate band for normal individuals without businesses or agricultural property. There are also some less welcome developments for those thinking about succession via employee ownership trusts. So again, on business owners, the capital gains tax relief on selling a business into an EOT which has been a popular route for succession planning. It's being cut from 100% to 50%. That means that owners will now pay CGT on half of any qualifying gains from that transfer. Doesn't remove the relief entirely, but it does reduce the incentive for owners to use that structure compared to the current or old regime. The government's view is that this still encourages employee ownership, but makes the tax relief more proportionate. Whereas in practice, it's likely to make some would-be EOT deals less viable. Key takeaway is that now is really important time to review your estate and succession plan. If you're running a business and considering transferring it into employee ownership, whether through an EOT or another route, it's worth looking closely at timing, valuation, and structure before the new rules fully take effect. Likewise, if you own agricultural or business property, make sure you're making full use of the reliefs available, particularly now that they can be shared between partners. Okay, so winners and support from the budget. It's worth saying that not every announcement in this budget was about rising taxes. There were also a few supportive measures aimed at easing pressure for certain groups. So good news, let's start with pensioners. State pension will rise again under the triple lock from April 2026. It will increase by 4.8%. That works out at roughly £575 more per year for those receiving the new full state pension. I'm sure there are some cheers in the crowd somewhere. It's a significant increase, and it reflects the government's continued commitment to protect retirees' income, particularly during a period of higher living costs. Next, the national minimum wage and the national living wage are both increasing. That's obviously positive news for low-paid workers, but it can also affect small businesses that rely on motivated staff, helping with recruitment retention in a very competitive labour market. For small businesses in retail, hospitality and leisure, the extension of reduced business rates multipliers and the continuation of transitional relief should help soften some of the property tax. And finally, there are still a few entrepreneurial and investment incentives that remain intact. Businesses investing in new equipment, technology, or startup ventures can still access allowances and reliefs that encourage reinvestment and growth. So while the budget focuses on revenue raising, there are some targeted pockets of support, particularly for pensioners, lower earners, and smaller community-based businesses. Okay, so what this means for you, practical advice for individuals. First, review your savings and investments. With higher taxes now applying to dividends, savings income and property income, it's worth checking whether you're making use of your tax efficient wrappers like ISAs, pensions. The changes to cash ISA limit may mean that you need to think differently about where your money sits and whether a stocks and shares ISA or a pension contribution might now be more efficient. There are other wrappers that we can look at that are probably beyond the scope of today's session. Next, if you're currently contributing to a pension, particularly via salary sacrifice, be aware of the upcoming £2,000 cap from 2029. It may be worth reviewing your contribution strategy and retirement projections now to see whether it makes sense to front load contributions, i.e. do it now, or adjust the way how you save. On the property side, if you're thinking about buying or selling, especially a second home or rental property, remember that both income and holding costs are increasing. And for high value properties over 2 million, the new council tax surcharge will add extra ongoing costs to ownership. Finally, this is a very good time to review your estate planning. With tweaks to business property relief, agricultural relief, and EOT capital gains tax changes, it's worth checking that your wills, trusts, and succession plans still achieve what you want them to. Particularly if you own a business or land or expect to pass on assets in the next few years, the rules have shifted, so it makes sense to review things now. So overall, This is about being proactive. The rules have changed. The best outcomes will go to those who take the little time now to realign their plans. What this means for businesses and SMEs, so for small, modest asset businesses, particularly those in retail, hospitality or leisure, there is some good news. Extension on business rate reliefs should help maintain cash flow. However, larger or growing businesses or anyone with higher value commercial property expect the opposite effect. The new high value business rate multiplier and ongoing property reevaluations will likely mean higher costs. If you're a business owner considering succession or sale, the change to capital gains tax relief on EOTs is a big one to note. Like we said, that value, the value of that relief is dropping from 100% to 50. It's a good time now to review those valuations, timing and structure, because in some cases, bringing forward or adjusting a transaction could preserve a better after-tax outcome. Before we wrap up things with key takeaways, it's worth stepping back and acknowledging that some of the broader risks and considerations come out of this budget. First, threshold freeze is one of the most powerful tools the Treasury has. By keeping income tax and national insurance thresholds static, more people are quietly being drawn into higher tax bands. You might not feel the pinch now, but over the next two to 3 years, it can make a considerable difference. For landlords and property investors, the combined effect of higher property income tax rates, the new high value surcharge will squeeze returns even more on top of the higher borrowing cost at the moment. We may see some investors exiting the market, which could reduce rental supply, and the only thing that happens there, rents go up. When it comes to pensions, this budget really underlines the need to revisit assumptions regularly. Many long-term retirement plans have been built on the assumptions that tax advantages like salary sacrifice will continue. They're not going to hold after 2029, so it's essential to review contribution strategies. And finally, estate planning and intergenerational transfers are becoming more complex, so thought needs to be placed around those as well. Okay, so strategic questions to consider for you or your business. Do you need to adjust your drawing strategy, salary versus dividends from 2026-27, especially if you run a small business, the landscape's changed. Should you accelerate or defer pension contributions, given the upcoming cap on salary sacrifice? For landlords, does the property still make financial sense, or should you change rental terms, sell, or restructure? For homeowners and potential buyers, does high value property still fit within your long-term financial goals in light of the surcharge? Should you review your estate planning now, especially if you have a business or agricultural assets? Okay, so to wrap things up, let's take a step back and look at the overall picture. This budget doesn't raise headline tax rates for income tax or VAT, and that's something the Chancellor was keen to emphasise, but it does shift the tax burden in more subtle ways through freezing thresholds, higher tax on dividends, property and savings, and additional property levies that mainly impact savers, landlords, and high-value households. In other words, people whose wealth sits outside regular employment income are the ones that will be contributing more. It's less about raising rates and more about broadening the base of who pays. On the other hand, there are pockets of support for those at the lower end, the minimum wage rise, state pension increase, and continued business rate reliefs for smaller businesses. For individuals with investments, rental income, or pension assets, and SMEs, this is very much a pivotal year. The tax landscape is changing, and those who review their plans early will be the best place to adapt. And for us as advisors, there's a strong case for us to reevaluate client portfolios, remuneration structures, and their estate plans to make sure every piece of their financial picture still fits under the new rules. So whilst this budget may not be headline grabbing, or at least not for the right reasons in the traditional sense, it's one that quietly reshapes how wealth is taxed and how businesses plan. The key takeaway is simple. The earlier you engage with the changes, the more options you'll have. So on to the questions and answers, and thank you very much for dealing with my intermittent coughing. Yeah, you only realise how much your throat dries when you sit here and talk for half an hour. So yeah, just going to open up to any questions now. So always struggle to find where the questions and answer box sits at the end of these sessions. So I may stop sharing my screen and see if I can find it. Okay. Okay, so questions and answers is looking a bit quiet at the moment, so I'll leave it for a few moments. If anybody wanted to put a question in the box, you're more than welcome to. Alternatively, if you'd prefer to speak in private and in person, feel free to book in a session with one of our advisors through that link or that QR code. My contact details are on screen. If you enjoyed the session or if you've got any feedback, please feel free to drop me an email. All feedback is welcome, but thanks for your time. Yeah, still no questions, so thanks very much all, and yeah, have a good evening. Oh, actually, excuse me, we have got some questions coming in. Okay. Yeah, so a couple of questions coming in around restructuring remuneration planning in light of the dividend tax rate. More than happy to help you with that. Just pick up the phone. Obviously, you've got my contact details. Philip may have picked out a few errors and omissions within the presentation. Obviously, we've got very limited time to put these together. Doing it live after a normal day's work, but yeah, I'll have a look into that, and if you don't mind, I'll confirm to you. But yeah, any other questions to raise? I'll leave it for a couple of seconds while I take a sip. Okay, so no other questions coming in. Thanks for those that did submit a question, and yeah, look forward to seeing you all at some point soon. Oh, we've got one last question, which is, will the triple lock continue given its costs? I think it's highly unlikely. I certainly am not expecting a pension from the state which is locked as it is at the moment. I think that's highly unlikely, but it's a ticking time bomb for any government that's in power. The voter base is predominantly older, coming up to state pension, if not in state pension age, and it could be political suicide for somebody to remove the triple lock. It probably needs to happen though, if we're being sensible about it. Okay. All right. Well, thank you for joining everyone, and yeah, look forward to seeing you at the next one. All the best.